Hi friends, good day. Today I'm starting a new chapter called as conversion and sale to a company. So far what we have discussed in dissolution of firm, the problems which we have worked out, this we have discussed so far. Dissolution of firm. In this, when all partners are solvent. When all partners are solvent, firm goes for dissolution. Then one partner becomes insolvent. Firm goes for dissolution. When all partners became insolvent and dissolution. These three areas we have worked out problem. Clear to all of you? The 3 points we have covered. That means first part has been complete. Dissolution of firm has been completed. When only the last point when I was explaining that about the treatment in balance sheet, treatment of loan, balance sheet, treatment of partner's loan. Say here something like B's loan. Okay. B's loan appearing on liabilities side. I think the slip of tongue, just I explained you, just if anybody is having the doubt, B's loan liabilities side means due to partner. Simple. It's a liability due to partner by the firm. I think somewhere I was watching that recording. It's like a slip of tongue. First time I've explained while writing that somewhere I missed a point. So this is what you should understand. Due to partner by the firm. That means firm has taken a loan from the partner. Due to partner by the firm. If suppose the same thing is appearing, if it appears on the asset side, if it appears on the asset side, say for example B's loan due from partner to the firm. So due from partner, this is due to partner is a liability, due from partner is an asset. These two things, just I want again reiterate that this is what treatment, right? Clear to all of you? Liability is nothing but partner's loan is a liability. This I have told you already, will not be transferred to realization account, will not be transferred to partner's capital account. But when it will be transferred to realization account, when entire all liabilities taken by the purchasing company, this will be transferred. This will be discussing one of the problem. Or when we transfer this partners loan appearing on the liability side to capital account, when all partners have become insolvent, this will be transferred to partners capital account. Clear to all of you? And due from partner to the firm will never be transferred to realization account. It will be always transferred to partners capital account. I think these things we have already discussed. Okay, my dear friends, I think this is what due to partner by the firm, because firm has borrowed the money. So due to partner is a liability, due from partner is an asset. Due from partner to the firm, that means to the firm partner owes money. Here firm owes money to the partner. Clear to all of you? I think this is what one point just I wish to quickly recap this. In fact, partner has taken loan. Here partner has given loan. Simple words. Partner has given loan. Here like partner has taken loan. Partner has taken loan. Okay, clear to all of you? Right. So I think these are things we have discussed so far. Now I think this is completed now. Okay, now coming back to this. In conversion and sale, what happened? As partnership continues to grow, the partners may decide to convert the partnership business into a limited company. I'm talking about conversion. Later on, we can talk about sale to a company also. But the concept is same. Either you convert the firm into a company or you are going to sell a firm to the company. First, the firm has to be dissolved. This is what you should remember. Conversion of a partnership firm into a company or conversion of partnership to a company or sale of a partnership to a company. In both the above cases, the firm has to be dissolved. In both the above cases, the firm has to be dissolved and accounting treatment also will be the same. Accounting treatment also same. So therefore, that is why we have given the common heading called as this can be taken as second part, conversion and sale to a company. So today's class, first I am going for conversion. Then we can work out problems on sale later on. So problems on conversion. Conversion of a partnership business into a limited company. When we talk about limited company, it can be private limited or public limited. It can be private or public. Okay. It can be private or public. Okay. Problems on conversion of a partnership business into a limited company. Clear to all of you? Now, so first let us discuss what is conversion. As partnership continues to grow, the partners may decide to convert the partnership business to limited company. Why they want to? In order to limit their personal liability. The main drawback of partnership firm is that unlimited liability. So we have seen in the last class, when all partners have become insolvent, they require to even bring their own personal property also. So that is a drawback. So that is the reason why most of the companies, partnership firms, willing to convert their their partnership business into companies, into a limited company. That is why LLP concept has come, limited liability partnership firms, right? I think that is a different thing, but we are talking about that. You are learned in the law also. Then second thing is that additional equity you need when firm is going for expansion. You feel that when firm is going for expansion, you feel that you need lot of what is that you can call as you need that additional capital to succeed in the business. You need additional capital to succeed in the business, because there is a good chance for expansion of business, but you are having some constraints. Whatever the contribution made by the partners may not be sufficient, because you need a huge investment. I think when you go for private limited company or public limited company, more number of people may contribute, and that's the business can grow. That is the reason why the a partnership firm will be converted to company. And then at the time of conversion, partnership is dissolved. So the entries which you have learned in dissolution chapter is same. What are the entries so far we have learned in general entries in dissolution in the beginning, first class? The same entries will be there. So no need to learn anything extra. But only thing is that you need to have few more points. What are the few more new points? Is that few more points is that one is whenever the firm is converting, like it's going for liquidation, you need to satisfy the existing partners, no, the partners who are in the firm. So for that, in simple words, when you're dissolving, and the same assets and liabilities will be taken over, handed over to a new company. So when you want to dissolve, and when you're floating a company, you want to see that what are the assets that can be transferred needed by the company, or what are the assets which are not required can be sold. Is this clear? What are the liability that is to be discharged, or liabilities can be converted into limited company liabilities? All these calculation you need to do. That is why when you are going for conversion, please remember purchase consideration. This purchase consideration concept is very important for not only for this particular topic partnership, also amalgamation of companies. What is purchase consideration? Purchase consideration is that when you are dissolving, it is being taken over by the new firm that has been floated by the, of course, the existing partners only become promoters, but still you need to, an accounting point of view, some amount is to be paid by the new company to the existing dissolved partnership firm. This is what is called as purchase consideration. That purchase consideration, generally I won't be discussing much about it. Anyhow, we'll be having an amalgamation of companies. That plays very important. Generally there are two basic methods: net worth method or lump sum method. Net worth means assets taken over by the purchasing company at an agreed value, minus liabilities taken over by the purchasing company or the new company at agreed value. Assets minus liabilities is equal to net worth or purchase consideration, and that is what we have to calculate. Or lump sum, he himself has given at 5 lakhs, they have agreed to take over the company, agree to take over the partnership firm. That is purchase consideration. So generally we will be discussing that lump sum, or what is it called as net worth method. These things we can discuss later on, or when problem comes we'll discuss. I'm not going to give much emphasis. Let us work out problems on purchase consideration, because in this anyhow we'll be having more discussion in company. The advantage you will be having is that after partnership, and when you go for amalgamation of companies, you'll be having huge advantage that you can have both comparison of these two things, right? So coming back to this, my dear friends, so the reason first I'm giving, as I told you, as partnership continues to grow, the partners may decide to convert the partnership business into a limited company private or public in order to A. Limit personal liability, B. Additional equity. Okay. At the time of conversion, partnership is dissolved. Okay. So let us write the accounting treatment. At the time of conversion, partnership is dissolved. Now, accounting treatment. Accounting treatment. All entries are same like dissolution except some additional entries. All entries are same like dissolution except some additional entries. Clear to all of you? Now, what are those additional entries? Let us start doing this. First one. For purchase consideration. See here before okay, I'll give you the entry. Entry is purchasing company account debtor to realization account. Okay, purchasing company account debtor to realization account for purchase consideration due. Purchasing company account debtor to realization. So we have learned already assets sold, cash to realization, uh, assets taken by partners capital to realization. Now assets taken by purchasing company, assets of course including liability, purchasing company relation. So we can write like this: cash oblique capital oblique purchasing company to realization. Simple. I think in this way we can remember, when assets has been realized for cash to realization, assets taken by partners capital realization, uh, net worth taken by the purchasing company relation. That's it. I think the only thing is you will be learning how to calculate purchase consideration, the purchasing company account data to realization. Clear to all of you? Here just int I am giving you this purchase consideration can be calculated by the following methods. The purchases can be calculated by following methods. Number one is net worth method. Or it is also called as net assets method. Okay, that is assets taken over by the purchasing company by the or purchasing. Same thing, even when you are selling the firm also same thing. Assets taken over by the floated company or purchasing company at an agreed values. Agreed value means like a 50,000 asset they may be taking for 60, or 50,000 asset maybe they will be taking it 40,000. This is important, an agreed value minus liabilities taken over by the floated company or purchasing company. This is also at an liabilities taken over by the purchasing company, by the floating company or floated company, or at an agreed value. So then this is what is called as net worth or net assets. And here assets taken over by the floated company includes goodwill. Sometimes we need to value goodwill, that we discuss later on when situation comes. Okay, I'm not making too much explanation in the beginning itself. This is first method. And second method is lump sum method, lump sum payment method. Or we can say net payment method. I think that will be easy. Net payment method, like they'll be giving purchase consideration is to be calculated on the basis of payments made by the company, like equity shares worth some amount rupees, preference shares worth rupees, cash, etc. Okay, this is what we talk about as a, this is purchase consideration. So we will be having two types of problems. In purchase consideration, we need to ascertain by following which method, net assets method. Or net payment method means how the payment is being made. Equity shares worth so and so, preference shares worth so and so, cash so and so amount. Then this becomes purchase consideration. This is how you should be calculating the purchase consideration. This net payment method itself will be saying that 5 lakhs. With 5 lakhs we are giving like this. So generally these two models we come across. When we work out that, we will be discussing more about it, and also the same points will be applicable even in case of amalgamation of companies also, that we discuss later on. Okay, right, coming back to this now. The first entry I have told you already, for purchase consideration due. Now what happened? That is, and the second one is entry for receipt of purchase consideration. Now you have to receive the amount, no? Entry for receipt of purchase consideration. Entry for receipt of purchase consideration. What is entry for receipt of purchase consideration? Purchasing company account debtor. Purchasing company account debtor. Sorry, just a minute. Entry for receipt of, you will be receiving that purchase consideration. Whatever the purchase consideration we have given there, it has been mentioned there. It will be received like this: shares in purchasing company account debtor, debentures. Sometimes they will be giving their debentures also. Debentures in purchasing company account debtor, cash account debtor, as the case may be. What are the payment they will be paying? And on these debentures, please pay attention. We discuss later on, because when we go for company account, you'll be having amalgamation of companies, you'll be having confusion on this. So this is the point we will be discussing again and again when we go for amalgamation of companies. But the receipt of purchase consideration can be debentures, but for calculating purchase consideration, we'll be discussing that in amalgamation of companies, debentures will not be taken into consideration. Please just pay attention. Don't worry much, don't think too much about it. If they are giving debentures, you debit debentures. Generally the payment will be in the form of shares or in the form of cash. Shares means it can be equity or preference. Shares means here equity and preference. So this is shares in it can be equity and preference. Clear to all of you? Cash account at R2. Purchasing company account. We have debited purchasing company. No, the purchasing company account has been closed now. You can see. This is what we will be writing the entry for receipt of purchase consideration. Please remember, these two are the methods. These two are the methods for calculation of purchase consideration. After knowing the calculation of purchase, after knowing the purchase consideration, then you start writing the entry for purchase consideration due. Then we start writing for entry for receipt of purchase consideration. Okay. Then after that, this purchase consideration, after getting this, ultimately it has to be paid to whom? It has to be paid to whom? Partners, because you need to settle their account, no? So for issue of shares and debentures, of course you know the entry for payment of cash, entry for issue of shares, entry for issue of shares and debentures to partners. And how you'll be issuing, that will be working out basing upon the information that is given in the problem. But just we are only writing the entry. Partners capital account debtor, partners capital account debtor to shares in purchasing company, to shares in purchasing company, to debentures in purchasing company. Partners capital account data to shares in purchasing company to debentures in purchasing company. Okay, this is how with this all the accounts will be closed. These are the entries addition to what we have learned in case of the resolution of the firm. Okay, we'll move on to the problem now. I've selected one problem here. Conversion and sale to a company. A and B were in partnership sharing profits and losses in the ratio of 2:1. They summarized balance sheet. A's capital, B's capital, current account A less B. Of course, B instead of showing on the asset side, they have shown on the debit, they have adjusted. B's loan 30,000, creditors 55,000. Okay. Fixed assets, current assets, stock, debtors, and bank balance. Okay, then the fixed assets include 2 motor cars having book value of 8,000, 6,000. So the 70,000 is including 2 motor cars book value at rupees 8,000 and rupees 6,000, means 8 plus 6 14,000. That means 70 minus 14 56,000 is other fixed assets. Simple words, just information there again, no need to worry about. So this 8,000 6,000 rupees is included in above fixed assets. This is included in 70,000 rupees. Okay. The partners desired to retire from the business accepted the offer of Western Indian Limited Company to acquire the stock and fixed assets other than motor cars at an agreed purchase price of 1,60,000. So the partners desired to retire from the business, accept the offer of Western Indian Limited to acquire stock and fixed assets other than motor cars. The purchase consideration was to be satisfied by a cash payment of rupees 56,000. The allotment by the company to partners of 400 5% preference shares of 100 each, and the balance in by allotment by the company to the partners 900 equity shares of 10 each. So I told you when we are working out the problem, given that all entries same like diesel except some additional entries, I have told you we are having a combination of problems of conversion of a firm into company and sale of. For sale also the treatment will be the same. Okay, so we don't have specific problem like that. Maybe 1 or 2 problems we are having, but most of the problems are instead of converting, we are having the problems are based on sale of firm to company. I told you in both the above cases, conversion of a partnership to a company, sale of partnership to a company, both the above cases, the firm has to be dissolved and accounting treatment also same. Just a minute, I think I got one problem specifically. I'll just tell you instead of taking this. Okay, I started now. I'll continue with this. No issue. This is, of course, I thought of taking only conversion of a firm into company. Conversion or sale, the thing is that firm has to be gone for dissolution. No issue. I think this is not conversion. It is not conversion. I think, just a minute. Offer of estate. This is sale. You are selling the firm to a company. Okay, but accounting treatment is same. Either conversion or sale. I told you accounting treatment will be the same. I thought this is a conversion problem, but it's a sale. The concept is same. Okay, anyhow. So I told you purchase price has been given. That is purchase consideration has been given in the problem here itself. We need not calculate purchase consideration. The purchase consideration was to be satisfied by a cash payment of 56,000. Allotment of company to the partners 400 5% preference shares of 100 each. And that balance by allotment of by the company to partners of 900 equity shares of rupees 100 each. It means this is how they are going to make a payment. That means here himself we got the problem information that the partners are the company has to go for dissolution, and then they have agreed to okay. So we are discussing this is conversion of a, not conversion, firm has been dissolved and the firm has been sold to a company. Now the purchase consideration has been given in the problem 1,60,000. The purchase consideration is satisfied by cash payment of 56,000, allotment by the company to the partners 400 5% preference shares of 100 each, and the balance by the allotment by the company to partners 900 equity shares of 100 each. Now when you look at this, sir, let us cross check, sir, whether purchase consideration is equal to 1,60,000 or not. This is cash 56,000. 400 preference shares of 100. 400 into 100. it is coming to 40,000 rupees. Then 900 equity shares of 100, 90,000. So 90 plus 40, 130 plus 56, 1,86,000. No, I think problem is wrong, sir. Don't come to a conclusion like that. I think first let me clarify, sir. Conversion of a firm into a company, or dissolution of firm and conversion of firm into company, dissolution of firm and sale to a company. Both concepts are same, my dear friends. No need to worry about it. Only difference is that existing partnership is converted into company. Here existing partnership has been dissolved. In both the cases, existing partnership has been dissolved, but you will be selling the firm to another company. That's it. The difference is same. So I think I've somewhere the problem is there. We are having for 30-40 problems. So I thought this is the first problem is conversion of a firm into company. No, it's not conversion. It is a sale of a firm to a company, but concept is same. Okay. So in both the cases, I told you we need purchase consideration. Now purchase consideration has been given 1,60,000. But he is saying that the purchase consideration satisfied by payment. I think it is not matching, no? Yeah. The reason is that here you can see the fourth point, connecting point here. Both the preference shares and equity shares to be valued at 80 rupees per share. Now let us see, not 100. Face value 100. This is into 80. Now you'll understand it. 40,000 into 80. 400 into 80. 32,000. 900 into 80. 72. Now you can check. 56 plus 56,000 plus 32,000 plus 72,000. It is coming to 1,60,000. Now you can see, clear to all of you. 100 rupees worth of share has been given at an agreed value of 80 rupees. So we got point number 1, purchase consideration we got, and how they are discharging the purchase consideration also has been mentioned. Okay, how they are giving that payment they are making, that is also been given. Now this is clear. Where we go for working notes later on. Now the thing is that, sir, what are the assets they are taking out, sir? Okay, they have given 1,60,000. No, they are purchasing the business. They say that we are going to make a payment of 1,60,000. Now what are the assets they are taking? That is important here. Debtors realized 61,000 and creditors were settled for 51,000. Okay, now you can see Western Indian Company Limited acquired the stock and fixed assets other than motor cars. So they are taking stock, they are taking fixed assets except motor cars. They are taking only 2 assets. Come on. Western Limited Company to acquire stock and fixed assets other than motor cars. That means they are only taking 2 assets, fixed assets and motor cars. That means fixed assets and stock. That means motor cars are left over, debtors are left over. Try to understand. What they are taking here, Western Limited acquired to stock. They are taking stock and fixed assets other than motor cars. That means their motor cars is being left out. Now what are the assets they are not taking? Motor cars they are not taking. They are not taking debtors. Now these 2 things has to be either to be sold by the partnership firm or it has to be taken by the partners. Okay. Similarly, we are having liabilities, 2 liabilities. Creditors we are having, BS loan we are having. Okay. Now let us see. They are not taking those 2 also. Now A to take 1 car. Acha, debtors realized 61,000. So debtors has been realized. Debtors realized for cash. Okay, this is realized in cash. Now, then he says that creditors were settled for 51,000. Creditors settled, creditors paid in cash. Okay, this is completed now. Now we are having only one liability, BS loan, and we are having motor car. Okay. Now the partners agreed that following. This is following. Following should be basis for distribution of dissolution of the partnership. A to take or 1 car at a valuation of 12,000. B the other car at 8,000. Motor car taken by whom? A and B. Okay. So 4 assets now totally are having. Other fixed assets, motor car. So you can simple say other fixed assets, stock This taken by company. Debtors realized in cash. Motor cars taken by partners. Total 4 assets we are having. 2 assets taken by company, 1 asset realized in cash, motor cars taken by partner. Now creditors paid cash. Now we are having loan, no? He has given. B2 be allotted preference shares to the value of his loan. The remainder shares to be allotted to A. So they are giving us preference shares also, no? Preference shares out of preference shares, they are getting 32,000 rupees. I think we have learned already. 400 preference shares somewhere he has given. 400 preference shares into 80, 32,000. And what is the loan to be paid? 30,000. After payment of B's loan, balance of 2,000 shares has to be given to whom? A. Okay. The equity shares to be allotted in proportion to fixed capital. What is fixed capital ratio? 5:4. Okay. This is clear. The balance is to be settled in cash. That means the amount that is payable to partners is to be settled in cash. You are required to prepare relation account, partners capital account showing the final settlement between them and the bank account. Now we will discuss about these things here. We arrange in a order. Okay. So solution first. Let us start solution for this. Receipt of purchase consideration. Let us write. Receipt of purchase consideration. Receipt of purchase consideration. Total purchase consideration has been given there in the problem itself. And how they are discharging purchase consideration also has been given. That means it is not like it is nothing like net payment method we have discussed. Here I give net payment method, no? Purchase do you calculate on the basis of payment made by the company like equity shares, preference shares, cash. That is what has been mentioned. Of course, total amount also has been given the problem. Total, it is nothing but lump sum and as well as net. It also sometimes some people they also call the lump sum. When the amount is given, lump sum and discharge of purchase consideration. Or discharge of purchase consideration is also you are having. You will be knowing the lump sum amount that is to be paid. So generally we will be calling net payment method, or it also sometimes can be called as lump sum. Lump sum is nothing but total amount 1,60,000 lump sum. How they are paying? So both information has been provided to us. Or through payment made by the company, we also can know the purchase consideration lump sum amount. Total purchase consideration is 1,60,000. Total purchase consideration 1,60,000. Next, receipt of preference shares. 400 into 80, no? We have seen already at an agreed value of preference shares and equity shares. Both preferred equity should be valued at 80 rupees per share. Okay. Then next, receipt of equity shares. Receipt of equity shares. Okay. Then they themselves has given balance is being paid in cash. Balance allotment by company. Cash also given. Cash is 56,000. They themselves has given. So cash 56,000. You are getting 1,60,000. Clear to all of you? Now as per the issue of preference shares and equity shares to partners. How you are issuing preference shares and equity shares to partners? Issue of preference shares and equity shares to partners. Issue of preference shares and equity shares to partners. So here we are having two partners A, B. Issue of preference shares. Here total preference shares 32,000 rupees. No, we already calculated 32,000. Out of 32,000, he says that B to be allotted preference shares to the value of his loan, the remainder to be allotted to A. What is the B's loan? 30,000. That means here out of 32,000, 30,000 is given towards B's loan. And balance shares given to whom? A. Total 30,000 rupees worth of preference shares has been received. Out of which 30,000 rupees worth of shares has been given to settle the B's loan. Balance shares has been given to A. Then he says that equity shares to be allotted in proportion of fixed capital. Fixed capital means here 50,000, 40,000, which is nothing but 5:4. In the ratio of 5:4. Okay. Now here, what is equity shares are 72,000. Issue of in proportion to capital. Fixed capital. He has used the term in proportion to fixed capital. We have got current account also. He is talking about only fixed capital. In proportion to fixed capital. That is 50,000 is to 40,000 or 5:4. So the 72,000 rupees we are allotting in the ratio of 5:4. So 72,000 into 5/9, it is coming to 40,000. And 32,000. That's it. How we have allotted, and preference shares, equity shares is given, and how much cash you are paying is like what we have done in the previous problems, that after closing the relation account, partners capital account, and amount due to partners will be equal to the cash available balance. That we will be knowing only after opening of the partners capital account. Now coming back to the problem, this is less just like normal way of doing the problem. So now what is that we need to do is that what are the assets that is to be transferred to realization account? As usual, I told you the entries which you have learned, the same concept will be followed. So fixed assets will be transferred to relation account debit side, stock relation account debit side, debtors relation account debit side, creditors relation account credit side. Okay. And B's loan of course will be transferred, will be a separate account is be open, because you are not giving them cash. B's loan discharged by giving preference shares. Okay. So this is what we need to do. And fixed current accounts will be closed by transferring to where? Capital accounts. Okay. Now here is given, you are required to open realization account, partners capital account showing the final settlement between them, and bank account. Okay, we do accordingly. First account which I am opening is realization account. The second account which I am going to open is partners capital account. Then third account, bank account. And for you to have a clarity, I'm also opening two more additional accounts. This is just like, it's like a tutorial note. You are not supposed to open, not required also. Tutorial note, I'm continuing this. Western Indian Company. Purchasing company. If you wish to, if sometime they may be asking you to open purchasing company account. That is why I'm opening, because to have a clarity of the entries which you have learned. Total not required in the examination. When he's not asking, don't open. Or if you open, there's no issue. But to keep you in good condition, to keep you in better understanding, so what I'm going to do is that I'm going to even open these two accounts, Western Indian Company, and then two more accounts I'm going to open, that is uh, equity shares in Western Indian Company, preference shares in Western Indian Company, and also B's loan. Okay, so these accounts I am opening in order to have a complete clarity on that this particular chapter. Right now, let me start. Fixed assets will be transferred to relation account. Including motor cars. Stock 35,000. To data 65,000. Bank account 15,000. Then A's capital 50, B's capital 40. Then next, A's current account also closed by transferring to capital account by A's current account. See, current account appearing on the liability side will be taken to credit side of partner's capital account. We are transferring. The entry is A's current account data to A's capital. In A's capital by A's current account. Then we are also having here, you might have noticed, B's current account less, means it is showing which balance? This is debit balance. So that is why don't take 10,000. A current account is independent, B's current account. You can't directly take 10,000. A is separate, B is separate. To confuse, he has given this. So B's current account debit balance will be taken to B's capital account debit side. The entry is B's capital account data to B's current account. B's loan actually we are discharging by, is not asking us to open account, but is just we are discharging by giving preference shares, just to have a clarity. By balance brought down 30,000 rupees have written. Okay. Next, Kratos 55,000. Kratos will be transferred to which account? Realization account. By Kratos account 55,000. Clear to all of you? So all these items balance sheet has been shifted. Now, what is purchase consideration? 1,60,000. What is entry for purchase consideration? Purchasing company account data to realization, I have told you. So here I am writing by Western Indian Company. Here I am using PC. PC means purchase consideration due. 1,60,000. And by cash, I think we are having cash account in the balance sheet. Bank account, sorry. By bank, debtors realized, I think 61,000. Debtors realized 61,000. And we are having two more assets, two motor vehicles that has been taken by partners. By A's capital, by B's capital. Motor cars taken over. Only additional entry we are having is purchasing company to relation. Remaining things are same. Motor car taken over, like just like previous problems. Motor car A is taken at 12,000, B at 8,000. Okay. Now, similarly, we also got some Kratos. Kratos were settled at 51,000. So that means cash is being paid to bank. To bank, Kratos paid 51,000. Okay, to bank, Kratos paid 51,000. That's it. Now, we can close which account? Realization account. Before I closing, let me go for the posting of these items. I have already opened Western Indian Company. No, in Western Indian Company, I will be writing to realization account. Because why I am opening this may be useful even for company accounts also, amalgamation of companies also. Sorry, 1,60,000. Then bank account, debtors realized to realization. Debtors realized. Debtors has been realized for how much? 61,000. What is entry, my dear friends? Bank account debtor to realization. Amount has been realized in cash. Then motor cars taken by partners, entry. Partners capital account debtor to realization. You learn the entries. If you don't remember the entries, if you feel like confusing. Motor cars taken over. A 12,000, B 8,000. A 12,000, B 8,000. Okay, this is completed. Now come back to this is Kratos has been paid. No, we should write on the bank account credit side. By realization, Kratos paid 51,000. Okay. Now we are left out with only B's loan. B's loan has been, acha, now we need to get the information like how the amount has been, shares has been discharged. We have seen here receipt of preference shares 32,000, receipt of equity shares 72, cash 56. This is purchase consideration received. So here when purchase consideration has been received, we should write entry. I've already given today's class entry for receipt of purchase consideration by shares in purchasing company. We are having two types of shares, sir. Equity shares in Western Indian Company 72,000. By preference shares in Western Indian Company 32,000. By bank cash 56,000. 6, 10, 6, 9, 16. Tallied 1,60,000. So purchase consideration has been discharged. Now in bank account I should write to Western Indian Company. To Western Indian Company 56,000. Clear to all of you? Then next we got preference shares in Western Indian Company has been received. Entry preference shares in Western Indian Company, equity shares in Western Indian Company to Western Indian Company. I have also opened equity shares in Western Indian Company. In West here the entry you can see. We learned the entry today. Equity shares in Western Indian Company to Western Indian Company. In equity shares in Western Indian Company we should write to Western Indian Company. How many shares? 72,000. What is the value of shares? 72,000. Similarly to Western Indian Company 32,000. Are you following, all of you? See, it's nothing but how we got shares because of purchase consideration. Now these shares has to be transferred to whom? Partners capital. So now 72,000 shares we have seen today how we need to make payment to partners. Here today I have started explaining 40,000 worth of shares has been given to A, 32,000 shares has been given to B, and 2,000 preference shares has been given to A, 30,000 has been given towards B's loan. So now in equity shares I am writing by A 40,000 shares, 40,000 worth of shares has been given, by B 32,000. So if you open these two accounts, then you will be having some clarity. That is the reason why I have told. But in the examination, when they are asking, this is not required. For your comfort zone, you can open these accounts. Preference shares 30,000 we have given towards B's loan, 30,000, and balance shares has been given to A, 2,000. So this account also has been closed. Okay, then next B's loan 2, preference shares in Western Indian Company 30,000. You can see entry I have written B's loan account data to preference shares in Western Indian Company. In preference shares in Western Company by B's loan. All the accounts have been closed. Now these entries I should write, go for posting in capital account. Capital accounts. 2, equity shares in Western Indian Company 40,000 A, 32,000 B. So preference shares in 2,000 shares has been given to A. That's it. So all posting have been completed. Now we need to go for realization account. So realization account, then we can close, finally we can close all partners capital account and cash account. I think in this case relation account credit side is showing more, 55,000 plus 1,60,000 plus 61,000 plus 12,000 plus 8,000. It is coming to 2,96,000. 2,96,000. 2,96,000 minus 70,000 minus 35,000 minus 65,000 minus 51,000. We are getting a profit of 75,000 profit we are getting. The 75,000 profit will be transferred to A capital and B's capital in the ratio of what is the ratio given? 2:1. 2:1, right? In the ratio of 2:1. So 75,000 will be given to A. 75,000 into 2 by 3. To B. 25,000. It is coming to 75,000. This is profit transferred. So remaining is same like partners. Only extra is that purchasing company account you have open, equity shares and preference shares. Everything problem, entire problem is same. Okay. Okay. So now we can go for the relation account has been closed. We can close the partners capital account. Then we will be knowing how much amount we need to make a payment. Our partners need to make a payment, because when you are giving shares to partners, then sometimes partner may be getting more than what you are required to make payment to him, or maybe amount is sufficient. That we will be able to know only through opening partners capital account. So here let me write the relation profit entry. So what is the entry for relation profit? Relation account data to partners capital account. So here I am writing by realization account profit 50,000, 25,000. Okay, now we can close the partners capital account. Then we can close almost all other accounts have been closed. Only we need to close partners capital account. Partners capital account may show credit side, may show more, or debit side. First let us check with the credit side total, then we can go to the credit side. We can go to the debit side. Let us check credit side total. 50 plus 20, 70 plus 50. It is coming to 1,20,000. I think credit side is showing more as far as A is concerned. B 40 plus 25, 65,000. Here also B is credit side is showing more. 1,20,000, 65,000. Then 1,20,000 minus 12,000 minus 40,000 minus 2,000. How much you need to pay? 66,000 to bank. Final payment. The conversion also same. Only sale is that some other company. Conversion, their A and B may become start A and B company. That's it. So you don't have much to do either with conversion or sale. That is why the heading is conversion and sale to a company. So no need to worry about it. Conversion means AB is converting to AB company. Here A and B partnership firm has been taken by Western Indian company. Difference is same. Okay, no need to worry, sir. You have started saying that conversion. No, it both are same. And I'll tell you, partnership accounts, relation account, previous things, if you continue, it will not be new. Only the thing is that you should focus from today onwards. If you do 2 or 3 problems, you'll be having more clarity. But today you go back and listen to again, sir, what is the purchasing company entry for due, purchase consideration, purchasing company relation, then how they are discharging purchase consideration, and how we are making payment to partners capital accounts. Partners capital account settlement we have already learned. Only what is that additional thing? Shares you are distributing to partners. That's it. Okay, so here 66, 65 minus 40, 50, it is coming to 15,000. This is final payment. Now capital account also has been closed. Now you can go for bank account. Bank account, here I am writing by Ace capital 66,000 by B's capital 15,000. Now 15,000 plus 61,000 plus 56,000. It is coming to 1,32,000. I think after making payment, it is to be 0. Let us cross check. Okay, yes, it's closed. So cash account also has been, bank account also has been closed. This account also has been closed, equity shares closed, preference shares closed. So this why I have opened tutorial note, because it's not supposed to open, because they're asking 3 accounts. Time management is the key. First, it is 1 or 2 problems I wish to open this account. So sometimes even if they're asking the account to be opened, you can open easily. And these purchasing company account and equity shares preferential account also will be useful for amalgamation of companies. In keeping that both I will be explaining, but after doing the problems, I think without opening these accounts also we can do. Simple words, if you don't open what we write here, by purchasing company, that's it. Okay, if shares are being given, you'll be writing 2 shares, that's it. And remaining accounts are not required. But to close the dual aspect of it, the first time you are learning how to open purchasing company account, so I have taken up this. Okay, this is simple problem, this is very simple problem, you have to practice, and we work out few more problems in the coming days. Okay, I hope you all are following this. A small correction, slip of tongue, I have explained you already, that liability said partners loan. Maybe I have noticed. It's not that initially, just I was explaining a slip of tongue. Maybe that's I've already explained in the beginning about the treatment of partners loan. Okay. So with that, let me conclude today's class, and we'll meet in the next class. Till then, goodbye. Thank you. God bless you all.